An asset's price collapses. The sell-off triggers a momentum reading that spikes straight upward, flashing a powerful signal even as the floor gives out. Retail traders often buy directly into these signals. They see a rising momentum indicator during a market crash, interpret it as an incoming reversal, and allocate capital, only to watch the asset continue to fall. This chart shows the asset's price in a severe downtrend on the top pane, while the bottom pane displays a rising average directional index. The average directional index, or ADX, is a technical indicator that measures the overall strength of a market trend. The math driving this line is strictly non-directional. A rising ADX line confirms the presence of a strong trend. It registers the force behind the market's movement, while completely ignoring whether the asset is gaining or losing value. Surviving quantitative trading requires completely separating the concept of a trend's velocity from its direction. Absolute trend velocity is the single measurement provided by the ADX. It tells a trader exactly how fast the market is moving, independent of the asset's specific price action. Velocity measures the speed of the trend. Trajectory dictates who is currently in control of that speed, the buyers or the sellers. To assign a positive or negative vector to the ADX's momentum reading, quantitative systems rely on the Directional Movement Index. The Directional Movement Index, or DMI, is a system of mathematical indicators used to identify the direction in which an asset's price is moving. Combining these two metrics allows a trader to engineer an emotionless, mechanical trading system based entirely on quantified output rather than intuition. Human discretionary bias must be stripped away by mathematically defining market regimes before a single dollar of capital is risked. Building this indicator strategy begins at the baseline, with naked price action on a standard chart. This chart shows the first component added to the price action, the positive directional indicator. The positive directional indicator, or plus DI, is a component line that measures the presence and strength of upward price movement. It strictly quantifies the aggregate strength of the buyers. The second component is the negative directional indicator. The negative directional indicator, or minus DI, is a component line that calculates the strength of downward price movement. This red line quantifies the aggregate strength of the sellers. The baseline mechanical crossover signal isolates the shift in control. A valid long entry requires the green plus DI line to definitively cross above the red minus DI line. The mathematical divergence, or the physical spread between these two DI lines, is what actually generates the black ADX line. As the gap between the buyers and sellers widens, the ADX rises. A wide spread equals a high ADX, proving a strong trend exists. When the DI lines cross repeatedly or become tangled, the ADX immediately drops, signaling a weak or non-existent trend. A DMI crossover is mathematically meaningless without knowing the underlying ADX velocity. The velocity confirms if the trend has enough power to sustain a trade. The ADX functions as a regime filter. It divides the market into two distinct bimodal environments, separating trending assets from consolidating ones. This chart shows the standard baseline for this filter. A hard horizontal line is set at the 25 level. Any ADX reading in the shaded green area above 25 dictates a trending market environment. Because the ADX is derived from moving averages, its primary mathematical flaw is that it inherently lags behind real-time price action. System builders use a strategy called threshold optimization to combat this inherent lag and capture entries earlier in the cycle. The mechanical confirmation threshold is adjusted down from 25 to 20. This expands the trending regime area to capture an earlier momentum shift. To prevent false signals from this lower threshold, a strict fail-safe is required. The plus DI and minus DI lines must be visibly angling in opposite directions, exactly as the ADX crosses 20. Optimizing these thresholds transforms an inherently lagging mathematical average into a highly responsive algorithmic trigger. With the threshold set, the first practical application applies to a high ADX regime, defined as an ADX reading firmly above the 25 mark. When the ADX is high, the asset is in a power trend. Momentum is fully established and directional control is locked. The strict mechanical rule for this regime requires executing trend-following pullback trades. This chart shows an asset in a strong uptrend. Rather than buying at the volatile peak of a breakout, traders wait for the price to dip down and retrace against a rising modal average, while the ADX remains safely above 25. The DMI lines confirm the pullback is safe. Even as the price briefly dips, the green plus DI line must remain mathematically dominant. Applying aggressive breakout strategies in a high ADX environment introduces unnecessary volatility risk. Pullback strategies capitalize safely on the established mathematical momentum. The opposing market regime is the low ADX environment, occurring when the indicator falls below 25. This specific phase operates as energy consolidation. The asset moves sideways, and standard trend-following strategies will fail catastrophically. In this regime, both the plus DI and minus DI lines typically hover at low levels. Neither buyers nor sellers have definitive control. This chart shows choppy sideways action. The rule here dictates drawing a precise horizontal resistance line across the peaks. The entry trigger occurs only when price breaches that resistance, while the ADX simultaneously curls upward from its low base. The ADX quantifies the exact moment a market switches from a consolidating environment to a trending environment. That exact moment dictates which mutually exclusive strategy must be deployed. Manually hunting for these specific DMI and ADX regime conditions across thousands of equities is inefficient and prone to human error. Systematizing these mathematical criteria requires a trading platform's automated scanner. This diagram shows the Boolean logic to program an automated long setup alert. Boolean logic uses true or false values to create strict conditional parameters. The logic runs: if plus DI crosses above minus DI and the ADX is greater than 25, then trigger the alert. This strict computational filter immediately eliminates discretionary bias from the screening process. True quantitative trading relies on algorithmic filtering. Every capital allocation is backed by empirical data, not emotion or guessing. The final edge of the ADX system is identifying momentum divergence. A dangerous scenario emerges when an asset's price continues to climb, achieving a new higher peak on the chart. This chart shows the divergence anomaly. Price makes two distinct peaks, the second higher than the first. But the ADX line fails to break its previous high, creating a lower peak. This mathematical failure indicates the trend's gas tank is empty, despite deceptive price strength. This divergence acts as a leading warning system. It transforms a historically lagging indicator into a predictive signal of an imminent trend reversal. The ADX does not tell you where the market is going. It tells you exactly how fast it is moving. Understanding this velocity dictates which mathematical rule set you must apply to survive and profit in any market condition.